Welcome to Your Money Guides, brought to you by Interface Financial Planning. Hello. Today I want to talk to you about the Enterprise Investment Scheme and the Seed Enterprise Investment Scheme for investors and companies. The Enterprise Investment Scheme, or EIS, offers one of the best tax schemes currently available to investors. It also provides a valuable way for companies, particularly smaller companies, to raise money. It's a rare example of a generous and relatively simple tax incentive in an otherwise complex tax environment. The government has enhanced the benefits and the value of EIS over the past few years as part of a broader approach to encourage investors to back smaller unquoted companies. In return, they offer investors a series of tax incentives. The combined value of these incentives can be exceptional in the right circumstances. Crucially, the EIS is enshrined by legislation, which means, unlike many other tax schemes, it's robust and protected from future uncertainties or whether the tax benefits will stick. This guide aims to help you understand the basics of how the scheme works and how the Seed Enterprise Investment Scheme works, how investors and business owners can benefit from them, and what you need to do to take this further in either case. It's worth mentioning at this point that the purpose of this guide is to provide an overview of the EIS and the SEIS for investors and for companies. It's a general purpose description of how the scheme works and the benefits to investors and companies. It's not a technical guide and will not cover every technical point. It should be noted that references to conditions and relief are based on existing laws and our understanding of HM revenue and custom practices as of 2020, and therefore subject to change. So let me start by looking at the EIS for investors. If you are looking to invest into a company, then you may be able to do so under the Enterprise Investment Scheme. You can take a shareholding in a qualifying company and obtain valuable tax benefits, or you could invest into a portfolio of qualifying companies through an Eis Discretionary Portfolio, where your investment is spread across several different EIS qualifying companies. The EIS offers investors more than one possible tax angle, and there are many advantages for investors investing a sum into an EIS qualifying investment. Essentially, there are 5 main tax benefits: income tax relief, capital gains deferral relief, capital gains tax exemption, loss relief, and inheritance tax exemption. There are many qualifying criteria around EIS qualifying investments, and I'll be talking about those a little later on. But now I'll briefly talk about the main features of each of these various tax advantageous elements. So firstly, income tax relief. An individual can reduce their income tax liability by an amount equal to 30% of the amount invested. The shares must be held for a minimum period of 3 years. The relief is given by way of a reduction of tax liability, providing there is enough tax liability against which to set it. There is no minimum investment amount. The maximum per investor is £1 million per tax year. There's also an additional £1 million per year limit for investments in knowledge-intensive companies. Also, individuals who have not used their EIS entitlement in the previous tax year can treat all or part of the cost of the investment as subscribed in that year, up to a maximum annual investment limit for the applicable year. Secondly, there's capital gains tax deferral relief. Tax on gains realised on a different asset can be deferred. The EIS shares you subscribe for must be issued to you in the period beginning 12 months before and ending 36 months after the date of the disposal of the asset against which you wish to claim the capital gains tax relief. There is no minimum period for which the EIS shares must be held, and this relief is not limited to investments of £1 million per annum. The deferred capital gain is brought back into charge whenever the shares are disposed of or are deemed to have been disposed of under EIS legislation. Next is capital gains tax exemption. No capital gains tax is payable on any sale of EIS shares after 3 years. This is, however, provided the EIS initial income tax relief was given and not withdrawn on those shares. Next, there's loss relief. If EIS shares are sold in the future at a loss, the loss can be offset against the investor's income in the year of disposal or the previous year. The loss is calculated less any income tax relief previously given. Alternatively, the losses can be offset against capital gains tax. And finally, inheritance tax exemption. EIS qualifying investments are exempt from inheritance tax after 2 years of holding the investment. Now let's look at the EIS for companies looking to raise funds. There are two sides to the EIS. On the one side, private investors seeking to invest into smaller companies, making profits and getting tax benefits. On the other side are companies that use the EIS to raise funds. Companies can raise funds through issuing new shares in their company, either through the EIS or the seed EIS, which I'll talk about in a moment. It's possible for a startup or a new company to raise money in its formative stages through the SEIS and then later down the line through the EIS. A company looking to raise funds via an EIS needs to consider a couple of points. Firstly, the tax benefits of an EIS are only available when new shares are bought. If the existing shares of an EIS-eligible company are bought on the secondary market, then none of the tax breaks are available via EIS. In addition, the company must have gross assets of less than £15 million before the share issue, with a cap of £16 million post-investment. They must also have fewer than 250 full-time employees, be trading in the UK, and be carrying on a qualifying trade. So now on to the SEIS. The Seed Enterprise Investment Scheme is the baby brother of the main EIS. It's a variation on the same theme, except it's aimed at newer and smaller companies. For investors, the biggest difference with the SEIS to consider is that the income tax relief is 50% and not 30%. This extra amount is a trade-off against the greater risk of investing into a newer business, which may not have the same survival prospect rate of a larger company. The income tax relief is available to individuals who subscribe for qualifying shares in a company which meets the SEIS requirements and who have a UK tax liability against which to set the relief. However, investors do not need to be UK residents. The maximum annual investment for investors to obtain relief is £100,000. A relief claim can be made up to 5 years after the 31st of January following the tax year in which the investment was made. All other tax benefits are as per the EIS. Now with companies, for its investors to be able to claim and keep the SEIS tax reliefs, the company must meet several requirements. Some of these apply only at the time when the relevant shares are issued. Others must be met continuously, either for the whole of the period from the date of incorporation to the 3rd anniversary of the date of issue of the shares, or in some cases from the date of issue of the shares to the 3rd anniversary of their issue. If the company ceases to meet one or most of those conditions, investors may have their tax relief withdrawn. Finally, there are requirements as to how the company must use the monies it's raised via the issue of relevant shares. Here are the main points for the company to consider. The company must be unquoted at the time of issuing the shares. It must have fewer than 25 employees. It must have no more than £200,000 in gross assets. Also, the company must not have had any investment from a venture capital trust or issued any shares of which it has submitted an enterprise investment scheme compliance statement, and the company may not receive more than £150,000 in total under the scheme. Any trade being carried on by the company at the date of issue of the relevant shares must be less than 2 years old at that date. That condition applies whether the trade was begun by the company or whether it was first begun by another person who then transferred it to the company. The company need not have started trading when it issues the shares, and the company must not have carried on any other trade before it started to carry on the new trade. The company must not be controlled by another company or another person connected with another company, and there must be no arrangement in place for it to be controlled by another company. And the company must be a UK resident or have a permanent establishment in the UK. If it's a single company, it must exist wholly for the purpose of carrying on a qualifying trade. A qualifying trade is one which is conducted on a commercial basis with a view to the realisation of a profit. Within 3 years of the date of the relevant share issue, all the monies raised by that issue must be spent for the purpose of a qualifying business activity. There's a significant list of excluded qualifying trades. Dealing in property, for example. In these cases, SEIS is not available. In both cases, where a company is looking to raise funds under the SEIS or the EIS, it's imperative that professional advice is sought and proper clearance checks have been undertaken before any shares are issued on this basis. The SEIS and the EIS offer great attractions to both companies and to investors. Here are some of the common considerations applying to both parties. For investors, don't let the tail wag the dog. There are tremendous tax benefits involved, but these would be outweighed if a bad investment is made. Investing into unquoted companies is risky, and if the investment goes wrong, the advantages of the tax breaks will be mitigated. In this respect, risk cannot be taken out of this type of investment, but take care that the risks are understood and weighed up. There's also the possibility to invest in an Eis Discretionary Portfolio, which may allow for the investment sum to be spread around several companies. This diversification provides an element of risk reduction. Also, EIS reliefs are particularly valuable for those who have a potential inheritance tax liability, because the sum invested can be used to reduce an estate value, and the qualifying period for this is 2 years, whereas many inheritance tax reduction schemes can take years to lock in or can involve passing an asset outside of an estate. I must, however, highlight that advice from a qualified source is crucial before any steps are made to invest via an EIS. Now, for companies, qualifying for EIS or SEIS makes the company more attractive for investors. For any company seeking to raise funds, it's worth exploring the EIS route to see if the qualifying conditions can be met. However, any fundraising requirement should be assessed based on the company's major business needs. It may be that issuing shares is less attractive than raising funds as a loan, and there may be other, possibly better ways of raising funds, for example through peer-to-peer loans or via a grant. The issue of shares via the EIS should be measured against alternatives. Again, advice from a qualified source is crucial before any steps are taken to raise funds via the EIS. So, in conclusion, as I have stressed throughout this guide, advice and guidance is crucial. These are areas with great potential, but they involve tight rules and qualifying criteria which you need to make sure are being met and will continue to be met. The continuing qualification is important because reliefs can be withdrawn if various criteria are not met for certain periods of time. Thank you for listening. For more information, visit our website at interfacefinancialplanning.co.uk.